Hi folks, welcome to Aner and Fraker's presentation. We call this one the third estate. So what I'm going to do today is we're going to show you kind of the rough illustration that we give our high net worth clients to help them understand how much tax money you can save by incorporating charitable planning into their estate. So let's start out by saying this is, for the sake of the illustration today, this is a $10 million estate. So it's a fairly large estate. And then what we're going to do is we're going to divide this into three separate columns, okay? One column, two columns, three. So the first column is what we call our tax-free column. And the tax-free column is exactly that money that you can pass on to your children without paying estate or gift tax. The second column here is what we call our taxable column. This is money that has not yet been taxed by the government, but is subject to federal estate tax. Okay? And then the third is what we call the social column. What I mean by the social column is this is money that is either going to go to taxes or to charity. Okay? And the neat thing about it is that you, as a family, have the ability to decide which one of these gets your money. So would you rather give your money to Uncle Sam, or would you rather give it to charity? So let's go back here, and in our fictitious $10 million estate, okay, the first column is what we call our tax-free column. Okay, the tax-free column, as we talked about, on the first death, what you put here in this box here, oops, let me pull this up real fast. What goes in the tax-free column right here is that amount of money which is free from federal estate tax. And on the first death, remember, there's never any tax at the first death. Okay, so what we're talking about here is the credit shelter trust. Okay, on the first death of the first spouse to die, you put in the maximum amount of money that you can shield from the federal estate tax. And in the year where the exemption is $2 million, you can put $2 million in the tax-free column, which leaves you obviously in the taxable column the balance of that amount of money. Okay, so if you take $10 million, you subtract $2 million tax-free, you have a balance of $8 million that is subject to tax. Okay, so we're going to put a line here. This line reflects the first spouse to die. Okay, so at the first death up here in this column, $2 million is tax-free and $8 million is taxable. Okay, on the second death of the second spouse to die, you get to add another $2 million. This is representing the other unified credit. Okay, each spouse gets a $2 million unified credit for a total of $4 million tax-free. Okay, I'm going to put a separate line here, a second line, reflecting the second death. Okay, which leaves us, obviously, if we've moved $4 million to the taxable column, then what we've really done is subtract $2 million from this column, and we reduce the number to $6 million taxable. Okay, at this point, without further federal estate tax planning, you have $6 million subject to federal estate tax. That's what the $6 million refers to. Okay, if you do no additional tax planning, this $6 million, half of it's going to go to taxes. Okay, so the federal estate tax due 9 months from date of death, in this case, is roughly $3 million, which is 50% of $6 million. The balance of it, now that it's paid its taxes, is allowed to go over here to this column and add $3 million here. Okay, which is what's left over after you've paid your taxes. So if you add up the tax-free column, 2 million plus 2 million plus 3 million equals $7 million. And that is the amount of money in a 10 million estate that you can pass tax-free to your children. Okay, but keep in mind, back over here, this $3 million sum is how much you're paying in federal estate tax. And if $3 million is going to Uncle Sam, IRS, you're paying a net effective rate on the entire estate of 30%. Even though the federal estate tax is a 50% rate, you got your two tax credits up here, your $2 million and your $2 million tax credits here and here. So that's why you're able to pay a net effective rate of 30% on a 10 million estate. Now, obviously, most families think that this is still way too much money, and they don't want to pay $3 million in taxes. Even though in this case, obviously, the kids are getting $7 million, they're still winding up okay. The question I get from our clients is, do we really need to pay this $3 million in taxes? So let me give you an alternate description of how this can happen. Give me a second. So let's go back to our original screen as we talked about before. Okay, here's our 3 columns magically cleared of all the data. So let's go back over here. And again, in this illustration, what we're talking about is how much money you can pass to kids and to charity instead of Uncle Sam. Okay, so again, let's come back over here. Sorry, that's not $3 million, that's $2 million tax-free at the first death. So this is again $8 million. And again, you get another $2 million tax credit, leaving it with 6 at the second death. Okay, so the second death, 2 million, 2 million, so the kids get 4 million automatically at the second death without further tax planning. So the question is, what can we do with this $6 million in the taxable column so we don't have to pay federal estate tax? Let me give you one really simple example. We call this one the charitable lead trust. Okay, a charitable lead trust works very much like a charitable remainder trust, except in reverse. What it does is it pays an annual income stream to charity. We'll mark this down here, a CLT. Oops, lost our ballpoint pen here. So the charitable lead trust is an asset that you can use to transfer the income stream to charity and take the corresponding tax credits and then move the balance of it to your children. Okay, so let's just use one. Some people use what's called rolling charitable lead trust or a series of charitable lead trust. Let's just use one. Okay, so we're going to plunk a full $6 million here into this charitable lead trust. Okay, at $6 million, we're going to set this up to go 20 years. And the reason we pick 20 years is going to become obvious in a second. Okay, we're going to move 5% a year to charity, and this can be your donor advised fund. We'll just put the word family charity here. This can either be a donor advised fund or your private family foundation. Okay, and what you're doing is you're actually making a series of 20 consecutive annual deductions. Or rather, you're making 20 consecutive gifts to your family charity. In exchange for that, what you're able to do, the IRS allows you to front load all your tax credits in the first year. So this again repeats itself for 20 years. So each year it's going to be giving out 5% of $6 million, which is $150,000 a year annually. So let's mark that down here. Okay, so each year that you give the $150,000, that's only going out annually. So this $6 million is being depleted by $150,000 annually. At the end of the term of years, at the end of 20 years, whatever's in this bucket of $6 million goes to your kids tax-free. Okay, so no estate tax on this. So what happens if your investment rate exceeds 5%, and the IRS's hurdle rates, then you actually will be putting $6 million at least, if not more, to the kids in their name. And that's something that makes this extremely powerful. Okay, so at the end of this process, the kids get $6 million because let's say that you've been growing it at an 8% growth rate, or just pick any number that's greater than 5 plus the IRS's hurdle rate. So if you're in the 7 to 8% range, this $6 million is going to remain level because you're only giving annual gifts of $150,000. At the end of 20 years, the family charity will have received 20 consecutive payments of $150,000 paid annually. And this is where the magic happens. So at the end of this process, the charity gets $6 million, right? Because 20 years at 5%, 20 times 5 is 100%. So you have zeroed out, this is called zeroing out your estate plan. You have zeroed out your taxable estate. You have transferred $6 million to your charity of choice, and you have also transferred $6 million to your kids, which is actually pretty amazing. Keep in mind, in the old column, you had $3 million going to the government and $3 million to your kids. So in the old example, your kids were only getting $7 million. In this case, you add up each of these estates to the kids, $2 million, $2 million, 4 million. Okay, and so that is from the 4 million, you're adding on another 6. So of your original $10 million, you're transferring 100% or $10 million to your kids. And at the same process, your charity gets this giant amount here, $6 million. Okay? So the downside to this, people ask me, well, why don't people do charitable lead trust all the time? The answer is, while this thing is doing its 20-year magic routine, you're not able to touch the money. And so kids, even though they're receiving $6 million at the first and second death, they're getting $6 million on their parents' death, they have to wait to receive this extra money from their parents until 20 years after mom and dad have died. So people say, well, what if kids don't want to wait that long? The answer is you can create a life insurance trust. I'll put that over here because that's also in the tax-free column. And then you can put in that box whatever you want. You get $6 million death benefit policy. And that way the kids get their 4 million immediately. They get another 6 immediately. That's 10 million immediately. And then 20 years later, they get an additional $6 million. And the family charity gets $6 million. Keep in mind, this amount of money is still under the guidance of the family. They get to decide if this is a family foundation, the family gets to pull a salary from this and give out 5% of this a year to charity. So it's not a requirement that this go to some unrelated charity. This can go to your family foundation. So at the end of the equation, your family has received $10 million straight up, and they've also received a $6 million family foundation. And that is the magic. In this case, the charity actually got more than the IRS was going to get had you just paid your taxes up front. That's the magic of doing the charitable lead trust, and that's the power of the third estate. Please call us with any questions. We'd love to hear from you. Have a great day.